Welcome, Monica.
Thank you.
Based in Brussels for the past 20 years, she's the owner of the TrustEuAffairs that informs and advises its clients on EU legislative relevant initiatives. We look forward to hearing what you have for us.
Thank you.
So while we wait for Monica, they're going to just pop her computer up here.
Thank you. You hear me fine? Do you hear me fine? Can you hear me? Yeah? Great. Good afternoon. My name is Monica. I'm coming from Brussels. My job consists of looking at what the European Commission does in terms of regulation about financial services and payments mainly. I've been doing this 24 years. First as Visa. I was their senior manager of regulatory affairs in Brussels, taking care for Visa of the relations with the European Commission, Parliament and Council. And I left in 2013 to create my own company, TrustEuAffairs. I own the company and I manage the company. I employ 8 people plus me, so we are in total 9. And the work we do is exactly this. Thank you so much. And the work we do is exactly the work I was doing for Visa before, which is basically taking care of monitoring what's happening in terms of financial regulation for my clients who are mainly not in Europe, and explain to them what regulation is about. And then the second part of what I do is really, once we analyze the regulation, is also look at how this should be improved. And so we start doing then position papers and meetings with Commission officials, with European Parliament members, and with the Council in order to progress on the regulation and try to improve the regulation. So what I'm here to talk about today is really what's happening in terms of regulation currently in Brussels as far as payments are concerned. So the 4 main files, I mean, there are many files, but the 4 main files we're progressing at, I wanted to talk to you about, are the following. So first of all, we have the instant payments regulation that was just finalized. Then I will touch upon the regulation for the European Digital Identity Framework, then the Digital Euro regulation, and then the review of the PSD2, the Payment Service Directive 2. Starting from the beginning, the instant payments regulation. The final act was published in the 19th of March, so this is now final. And what the instant payments regulation is telling the industry to do is the following. So payment service provider, any payment service provider that offers credit transfers will be obliged to also offer their payment service user a payment service of sending and receiving instant credit transfers. And they shall ensure that all the payments accounts that are reachable for normal credit transfers are also reachable for instant credit transfers. And this 24 hours a day and any calendar day. Now, when the Commission announced this, this was very controversial, and there was a lot of discussion in the industry, for example, on how to do the monitoring of these transactions from a fraud perspective, on how to ensure really instant all the time. But the regulation is now final, and we are looking at compliance. Now, what is also interesting here is the amount that can be transacted and transferred by instant payments. And what the regulation says is the following. Upon request of the payment service user, the payment service provider will have to offer this user the possibility of determining a maximum amount that is able to be transferred by means of instant payments. So this limit can be per day or could be per transaction basis, but it's for the consumer to decide. So this is already very interesting. You know, when I started to do this work around 25 years ago, most of the regulations were not about what the consumer would like to have as a service. It was about what was feasible and what would serve the ecosystem. I've seen in progress in these 20 years, really the focus has been moving from what is feasible to what the consumer desires and would like to have. So this flexibility about the maximum amount, for example, this is something that indeed is in the text for the user to decide which is the maximum amount they would like to transfer as instant. Now, in terms of timeline, they've been looking at how to make this work for not only payment service providers who are banks, but also for payment service providers who are not banks, namely e-money institutions and payment institutions. And what they decided to do is to really divide this into different timelines. So who has to provide instant payments regulation, instant payments in Europe, and by which date? So for payment service providers that are located in the member states where the currency is the euro, we have the offer of receiving instant payments in euro will have to be provided by the 9th of January 2025, so next year. And for sending instant credit transfers in euro, this will be the 9th of October 2025. But this is only for payment service providers that are banks. For payment service providers that are electronic money institutions, so they are licensed as electronic money institutions, and for payment service providers that are licensed as payment institutions, they will have until the 9th of April, so 2027, so they will have extra 2 years, for providing this service of sending and receiving instant credit transfers in Europe. Now, they can do before, but they will be obliged to do only by the 9th of April of 2027. And normally, when I explain this outside of Europe, people ask me why. Well, the reason is access to the central banking infrastructure. Banks already have access to the central banking infrastructure. E-money institutions and payment institutions don't have yet access to the central banking infrastructure in Europe. And so why? Because access to the central banking infrastructure is regulated by a piece of law which is called the Settlement Finality Directive. And this Settlement Finality Directive only currently allows this central banking access to banks. And so what the regulator has thought, how can we oblige payment institutions and e-money institutions to provide instant payments if they may not have the liquidity which is necessary to provide this service because they do not have yet access to the central banking infrastructure. And so what they decided to do is first to amend the Settlement Finality Directive so that also payment institutions and e-money institutions can grant access to the central bank infrastructure and system, and only then they will be obliged to provide instant payments. So it's very interesting here because the discussion and the thought of the regulator is about what is feasible for the industry in terms of liquidity. Which kind of liquidity actors need to provide instant payments? And so the whole idea was to have payment institutions and e-money institutions compete on the same foot with the banking industry. But in order to do so, they should have exactly the same liquidity access. And that's how the regulator structured this in this way. So the difference in timeline is because it will be required, a couple of years will be required to amend the Settlement Finality Directive and for this to become applicable so that also e-money institutions and payment institutions, which are not banks, will have then access to central banks' liquidity. And then will be obliged to provide instant payments because they will have the liquidity that goes with the service. So I think it's very interesting because it shows how for the Commission is really a priority. When I say the Commission, is the European Commission. Now we call it the Commission, but I guess there are plenty of commissions here too. So when I say Commission, it's the European Commission. So the European Commission is doing this because they want to create what they call a level playing field. Level playing field between the banks and the non-banks, who are also financial services actors. And to create this level playing field, the first thing they're doing is creating access to central banks infrastructure for non-banks. Now, in terms of the charges for these credit transfers, of course, the Commission didn't want instant payments to become too expensive. So what they decided to do for charges on instant payments was to say that the charges for instant credit transfers shall not be higher than the charges that would correspond to a normal credit transfer, so that the cost for the customer is not higher. This is also something we were discussing this morning, the relation between the will and the wish to provide a service and its cost. And so here, what the European regulator thought is to have the same cost, so that it's not more expensive for consumers, and so that they will indeed use instant payments. And then, to avoid fraud, they are also building this system of verification of the payee in case of a credit transfer. And this verification of the payee shall be offered free of charge, regardless of the payment initiation channel which is used, immediately after the payer provides the information about the payee and before the payer is offered the possibility to authorize the credit transfer. So by now, normally people ask me, but if the cost is the same, and then even the fraud checks are for free, why institutions should be providing this service if they don't gain anything on it? Well, this service indeed of instant credit transfers will not in itself be an opportunity to gain more money. But all these services which are attached to this, it's the what we call the plus. So all the plus services is something that banks and payment institutions and e-money institutions could charge for. So in the end, this is going to be profitable for the business, even if it's not immediate to see this when you when you just look at the text of the regulation. So that was the instant payments regulation. Second one I wanted to talk to you about is the regulation for the EU digital identity. This was just finalized in April now, and this is about a European digital identity wallet that is going to be used to store electronic identification data, but can also be used to pay. So it's going to be used, for example, as authentication when you are paying. Now, the idea will be also to have this European digital identity wallet also tracking all the transactions. So the time and the date of the transaction, the counterparty identification, the personal data that are requested, and the data shared. The idea being indeed that we could use this European digital identity wallet, for example, opening a bank account or for payment, both online, but also for authorizing payments, as a form of strong customer authentication. Also, we could be used for KYC, for Know Your Customer, and also for storage of digital euros. Now, this is very interesting because this is really moving the whole idea of payments going through a card to payments going via a wallet. And this wallet will not only be a way to store cards, but maybe also a way to store digital euros, and it will at the same time provide a mean to identify when you're paying. So it's really, the idea will also be to have this European e-identity wallet, not only for people, for users like us, but also for companies. So it will also allow, for example, onboarding in B2B. And it's very interesting to see how the Commission is thinking about this, because despite we don't have yet the digital euro, and they're still building the digital euro, they are trying to connect the EID wallet to the digital euro so that the interface could be the same. And so it would be very smooth for the user to use the EU digital identity wallet also for storing and paying with digital euros. Then we have the digital euro regulation. This is not final. This is still ongoing. The Commission has put out let's say the draft proposal, and this is still into discussion. The idea really is to use the digital euro both online and offline. Now, why offline? Because the idea is really that the digital euro should be usable also by people who are not necessarily financially included per se. So even people who don't necessarily have great knowledge of how to use a mobile phone or how to use a computer. And so the idea is to be able also to use the digital euro offline for offline transactions. Here, all the discussion about equivalence to cash becomes very important, because there's been a lot of discussion, especially in the press in Europe, about who will have then the data that are related to the transactions. Because of course no users wants a central bank, a national central bank, or the European central bank to know where these transactions are taking place and what are you buying. So when the Commission did a public consultation on the digital euro 1.5 years ago, a lot of consumer associations started to write long position papers explaining that this was against the general data protection regulation, because then central banks will have all the data about spending of citizens, and they could use that for tax purposes. I mean, you see where I'm coming from, you're nodding. Yes. So what the Commission decided to do is to draft the text in a way that the data would be protected with some form of pseudonymization, so that the central banks will not have all the data about these transactions in the digital euro. And they also included in the regulation something explaining that not even commercial banks who are distributing the digital euro would be able to use the data related to the transactions in digital euros, so that the transactions and the content is somehow preserved. And this is one of the, let's say, this is one of the points the Commission is using for having users to commit to use the digital euro. This form of pseudonymization that will make it very similar to cash, but indeed traceable, but traceable not in terms of where the money is spent, but in terms of volume of transactions. So again, the text is still in the making, but this point of the pseudonymization and encryption of the personal transaction data is something which is extremely important for the audience then for the users to then them adopt the mean of payment. Now, the second issue which arises after data protection is the issue of liability. Who is liable towards who? Because there will be no contractual relationship between the digital euro user and the central bank. The contract will only be between the the commercial bank, which is distributing the euro, and the user. And so there is now all a reflection about how to modify the text for having in place also some form of liability between the banks and the central banks. So as a user, there will be no liability whatsoever for the European Central Bank based on a contract, because there is no contract. We could imagine an extra contractual liability towards the central banks, but there will be a liability very likely between the banks, the commercial banks and the central bank via some form of contract that they will establish between the two entities. The idea being that the user should be protected, but also the commercial banks should be protected and be only responsible for the part of the transactions and for the part of the operations that they are working on. So how they are building this, they've been looking at, of course, Visa and MasterCard as infrastructures, and they are trying to create a similar infrastructure that we see as main actors, the central banks. So this is still ongoing, also because of the European Parliament elections that we just had. And here again, who will be able to distribute the digital euro? Well, the banks will be obliged to do. The payment institutions and the money institutions will have the option to do. Why? Again, liquidity. They will be able to do, but it's an option for them because it depends on the level of liquidity that will be decided, that will be granted. Now, in terms of which are the controversial issues or what is still discussed, first of all, the holding limit. How many digital euro as a citizen I can hold? Or how many digital euros as a company I can hold? They are making a calculation and they're trying to understand which kind of level of digital euro holding will be safe enough for the commercial banks' savings accounts not to be emptied. Because the risk there is disintermediation of the commercial banks, of course, if it was possible to hold very large amount of digital euros. So this is something they're still looking at. And then the second part is the fees and the compensation. So the digital euro is a public good. It has a legal tender status. So there are costs for intermediaries and for merchants because it will be mandatory to accept it, and the free basic services will be provided, of course, for free. So they are looking at which kind of fees and compensation mechanism should be in place for the banks and for the payment institutions, any money institutions, to be engaged in the distribution of the digital euro. So the part about the fees and compensation and the part about the holding limits are really the, not most controversial, but the parts of the text where there is still some discussion. Last but not least, we have the review of the Payment Service Directive too. So on the 23rd of April 2024, the European Parliament, the previous European Parliament, we have now a new one since June, they adopted their report, so their position on the revision of the PSD2. And now we are waiting for the second part of legislative procedure. So what happens now is we have a final text from the European Commission, which is the original draft text. Now we also have the final text from the Parliament. What is going to happen now? The Council, so the 27 member states, they are also putting together their position. And they will start normally in January what we call the trialogues. So trialogues is a dialogue between three parties, the three parties being Commission, Parliament, and Council. And they will start this work in January normally to finalize the text. So a final revision of the PSD2 is normally expected by, at the latest, June 2025, very possibly earlier. Then we will have a final text. Interesting enough here, the Commission has divided the text in two parts. So instead of going for Payment Service Directive number 3, they divided this in two parts, a regulation and a directive. So we will have PSR 1, Regulation of Payment Services number 1, and PSD 3, so Payment Service Directive 3. Why? Because under European law, a regulation is directly applicable and is much less flexible. So member states will have to do exactly what the text is saying. And what they saw with directives, which have to be implemented at national level, is that member states may gold plate some provisions, interpret some other provisions, and that we may end up having 27 different versions of the directive. And so what the Commission did this time, the core provisions that are going to apply to industry, they are in the regulation. So this means that for those, there will be very little discrepancies and changes between one member state and the other. The more general provisions, they are staying in the directive. So there will be some flexibility at member state level on how this will be implemented. Again, I have another 2 minutes. I have another 2 minutes? Fantastic. Then in terms of what this PSR and PSD3 include, well, they are also including in here the revision of the second e-money directive. And they are creating some form of, let's say, new category of payment institutions. So you may not be very familiar with the difference between payment institutions and e-money institutions, but I could explain this in this way. We have first banks that can do everything, from taking deposit to providing credit to issuing e-money, to issuing prepaid cards. And then the e-money directive created e-money institutions. They are not banks, and they can issue prepaid. They can also issue credit as ancillary service to prepaid with contracts of maximum 24 months. But the Commission wanted to create more competition. So I have new actors, which are not banks and not e-money institutions, but still compete with banks and e-money institutions for the consumers. And so via the Payment Service Directive 1 in 2007, they created the new entity called payment institutions. And this could do everything, so any type of payment, other than, of course, accepting deposits because they're not a bank, and except of providing prepaid because they're not an e-money institution. But the rest of the payments they can do. And when we see now, payment institutions are developing so much, and they are getting larger in scale, the regulator has thought that maybe payment institutions and e-money institutions could be in the same category. So they are reviewing now the PSD2 to, let's say, include in the same category even e-money institutions that would be a type of payment institutions, which will mean that payment institutions will also be able to issue prepaid, of course also issue credit under certain conditions. The idea of the legislator being always the same: increase competition, create level playing field between banks and non-banks for the benefit of the users being consumers, but also users being SMEs, who, as you know, are over 70%, if not 80% of the companies in Europe. And so in terms of when we are expecting the final, I was very optimistic when I put this together. I said Q1 2025, maybe Q2 of 2025, but definitely the first half of 2025. And then, of course, it has to be implemented. So it will take a certain number of months, and you have here the timeline for that. So this was my presentation. I hope this was not too boring. I'm passionate about European law, but I know it's not the same for everyone. But if this can be of any use or of any, let's say, inspiration for your work, I was very pleased to present to you. Thank you.
Thanks, Monica. And we'll have more of Monica a little bit later on when we have a panel discussion, and so we can always direct some questions at her and the rest of the panel a little bit later on.
There was already a question, but you killed it. Can I take just one question and then I leave you in peace?
Yeah, quickly over there. Thank you so much.
Yes,
Thanks,
I'm
Monica.
insisting for this question, just because all the other speakers got a question.
All right. So in the context. All right. So in the context of Europe, I'm particularly keen to understand. You mentioned leveling the playing field between the banks and the non-banks.
Yeah.
How do you see that working out? What needs to happen? I understand it in the context of Southern Africa, but I just want to hear how they could do that, because the landscape is different.
It's a very good question. I would say the criteria, in my view, are two. The first criteria is about liquidity. To compete, you have to have the same liquidity access. This is why they are simply reviewing the settlement finality directive. Otherwise, the competition will not be on fair grounds. The second one is sharing of data. It's access to data. And the portability of this data also. Let's say you get a better offer for a service from an entity which is not your bank, and maybe it's not even a bank, it's a payment institution or a money institution. Then you have to allow portability of your data. And I think part of the data is also about what we call open banking or open finance. So the possibility of the actors to share this data. Now, personally, I think this should not be only payment institutions and money institutions having access to bank data, should also be on the other side, allowing payment institutions and money institutions to also share their data with the banks. But I would say access to data and access to liquidity are, at least in Europe, the conditions I've seen this far in my work that can improve and enhance the level playing field. Yeah? Cool. Thank you very much for your attention.
Thanks, Monica.